Welcome back, everybody. We've got something special for you today. We're taking a deep dive into Giverny Capital. A listener sent us a whole stack of Giverny's annual letters going all the way back to the 90s.
Oh, wow. Going that far back.
Yeah, it's amazing.
That's like a time capsule.
Yeah, exactly. It's like a time capsule into their investing journey, and we're going to unpack it together. So,
Sounds fun.
yeah, let's jump right in. What kind of value has Giverny actually delivered for their investors over the years?
Well, their U.S. portfolio has an annualized return of 17.4% since 1993. Just to put that in perspective, the S&P 500 returned 10.5% over the same period.
So that's like an extra almost 7% each year.
Exactly, 6.9% to be precise. And that's a huge difference, especially when you think about compounding over such a long time.
Okay, that's a big number. But everybody always talks about long-term performance. What about when things get a little rough? How do they handle the market turmoil, during those years?
Well, that's where it gets really interesting. Take 2007, for example. The subprime mortgage crisis was unfolding, markets were in free fall, and even then, Giverny still managed to outperform the S&P 500.
So they didn't just avoid disaster, they like sailed right through it.
They navigated it skillfully. Yeah.
Pretty impressive. And wait, didn't 2008 get even crazier? Like the whole financial system was going haywire.
Oh, absolutely. You're right. During the 2008 financial crisis, while most people were just hoping to break even, Giverny's portfolio grew by a whopping 141% between January of 2008 and the end of 2009. For comparison, the S&P 500 only gained 54% in that same time.
Whoa, so they didn't just weather the storm, they actually like thrived in it.
Yeah, pretty much.
That's amazing. Okay, so these numbers are definitely impressive. But what's the secret? What's driving their success? Is there a specific philosophy or approach they've been following?
Well, one thing that really pops out in their letters is this focus on the long term. They consistently emphasize staying calm amidst market swings and, not getting caught up in what they call the flavor of the day.
Flavor of the day. You mean like the trendy stocks that everyone's chasing?
Exactly. The investments that are hot one minute and gone the next, Giverny sees those as distractions. They're much more interested in finding businesses with intrinsic value that will stand the test of time.
So they're not afraid to kind of go against the grain, be contrarian when they see a bubble inflating.
Yeah, that's right. A great example is back in 2006. Canadian banks were like the darlings of the market. Everyone loved them.
Canadian banks, those always seem like pretty safe bets.
Yeah, that was the common wisdom at the time. But Giverny saw something different. They were cautious, sensed potential trouble on the horizon, and guess what? They were right. Canadian banks underperformed in the years that followed.
Wow, calling the top on Canadian banks. That takes some serious conviction, especially when everyone else is piling in. So they definitely have a knack for seeing value where others don't, even if it means, going against the crowd.
Absolutely. And they also have a knack for spotting incredible leadership. One of their big wins, Disney, really showcases this. They invested when Bob Iger took over as CEO in 2005, and we all know what happened there. Disney stock went up over 200%, adding a huge amount of shareholder value.
It's like they saw the magic before anyone else. But choosing a CEO as a buy signal, isn't that kind of risky?
It can be, but Giverny firmly believes that the right leader can transform a good company into a great one. And in Disney's case, they were spot on. Iger's vision and his execution, those were key drivers of that incredible growth. They did something similar with the Bank of the Ozarks. It was kind of a regional bank flying under the radar at the time.
What's so special about Bank of the Ozarks?
It was all about the CEO, George Gleason. He had this incredible track record and a very clear vision for the bank. Giverny recognized that potential and invested. And that investment doubled in just 5 years.
Wow, so they were really focused on strong leadership as a sign of future success.
Yeah, it's a key indicator for them.
It seems like they have a real talent for identifying these hidden gems, these companies that are poised for explosive growth. But even the best batters strike out sometimes. What about those times when Giverny kind of missed the mark? Everyone talks about their Amazon miss. Ah, yes, the Amazon miss. Even the best investors don't have a perfect track record, and Giverny's no exception. They readily admit they missed the boat on Amazon. Now, so what happened there? Did they just not see the potential of e-commerce?
They understood the potential, but they were hesitant about its valuation and its unconventional approach. They even called it a cult stock in one of their letters.
Ouch, that's got to sting a bit to see a company like Amazon take off when you were on the sidelines, especially if you understood the core idea.
Yeah.
Any other big misses that they talk about?
Yeah, they've also highlighted a mistake with Cabela's, an outdoor retailer. They recognized its value, but they waited for an even lower price, ultimately missing out on a massive 300% gain.
Yeah. So even Giverny isn't immune to getting a little greedy, huh? But it's refreshing to see them being so open about their mistakes. Not many firms would be so transparent.
You're absolutely right. It's a valuable lesson for all of us. Sometimes a good price is good enough, and trying to time the market perfectly is a recipe for disaster.
Okay, so we've seen that Giverny is all about long-term thinking, identifying quality businesses, and betting on strong leadership, even if it means going against the grain. They're not afraid to make bold moves, and they're transparent about their wins and losses. But how does all of this translate into their actual portfolio management? What's their approach to building and managing their portfolio?
That's a great question, and it's what we're going to explore next. Their approach to portfolio management is just as unique and insightful as their overall philosophy.
So we've seen that Giverny has this very unique philosophy looking for quality businesses and strong leaders, and they're not afraid to be contrarian.
Yeah.
But how does that actually play out in their portfolio? I mean, what does their portfolio management look like?
Well, they actually challenge a lot of the conventional wisdom when it comes to portfolio construction. For example, they don't really subscribe to the typical buy and hold dogma that you see so much in the market.
Buy and hold, you mean like pick your stocks and just sit on them forever?
Exactly.
Yeah.
That's the classic approach. But Giverny sees things a bit differently. They actively buy and sell based on their ongoing assessment of a company's intrinsic value.
Hmm, interesting.
Yeah, they're not afraid to take advantage of market fluctuations, buying when others are fearful and selling when others are greedy.
That sounds a lot like value investing, right? Buying low and selling high. But doesn't that require a lot of market timing? And isn't that supposed to be impossible?
A lot of people would say so, but Giverny doesn't believe in trying to predict short-term market movements. They just focus on identifying companies that are trading for less than their true worth. They see the market's irrationality, its tendency to overreact in both directions, as an opportunity.
So they're using the market's volatility to their advantage, kind of turning that conventional wisdom on its head.
Exactly. A great example of this is their stance on bonds back in 2008. Remember, everyone was fleeing to the perceived safety of bonds, especially treasuries?
Yeah, weren't bonds considered like the safe bet during the financial crisis?
That's what most people thought, but Giverny saw something that many overlooked: inflation. They warned that the massive influx of money into treasuries would lead to inflation eroding the purchasing power of those supposedly safe investments. They even called bonds a guaranteed path to impoverishment due to inflation.
Whoa, that's a pretty bold statement, calling bonds a path to impoverishment. But they've been pretty vocal about inflation for years, haven't they? Even when it wasn't such a popular topic.
They have. They've consistently warned about the dangers of inflation even when it wasn't on most investors' radar. And, their concerns about inflation are even more relevant today than they were back then.
Yeah, that's true. So they're not just looking for undervalued companies, they're also thinking about the big picture, the macroeconomic landscape and how that might impact their investments.
Exactly. They're looking at the bigger picture, considering both the micro and macro factors that could affect their portfolio. And this brings us to another interesting aspect of their portfolio management: position sizing.
Position sizing, you mean how much they invest in each company?
Precisely. You see, most investors try to spread their risk by diversifying across a large number of stocks. But Giverny takes a different approach. They're not afraid to concentrate their bets on a few exceptional companies that they really believe in.
So they're putting more eggs in fewer baskets. Doesn't that seem a bit risky?
It is risky, but they're not making these decisions lightly. They do their homework, they understand the businesses inside and out, they've researched the management teams, and most importantly, they have strong conviction in their analysis. For them, it's about focusing on their best ideas rather than diluting their returns by spreading their capital too thin.
So quality over quantity.
Exactly.
So instead of hedging their bets with dozens of companies, they're going all in on the handful that they believe in the most.
That's right. And their track record suggests that this concentrated approach has worked out pretty well for them.
Do you have any examples of how this has played out in their portfolio?
Sure. Take 2011, for example. The market was experiencing a dip and many investors were pulling back. But Giverny saw this as an opportunity. They increased their positions in two companies they believed were significantly undervalued: Berkshire Hathaway and Wells Fargo.
Berkshire Hathaway and Wells Fargo, huh? Those are some pretty big names. What made them so confident in those particular companies?
Well, they believed that both companies had strong fundamentals, solid leadership, and were well positioned to weather the economic storm. And you know what? They were right. Over the next 5 years, both Berkshire and Wells Fargo outperformed the S&P 500 by a healthy margin.
Wow. So their conviction really paid off. It seems like their approach to portfolio management really boils down to this: deep research, careful selection, and the courage to bet big when they see a compelling opportunity.
You got it. It's a fascinating departure from the conventional wisdom of broad diversification. It's a good reminder that sometimes the best way to manage risk is to go all in on your best ideas.
Okay, so we've covered a lot of ground. We've seen how Giverny's philosophy translates into their portfolio management. They challenge traditional thinking by actively buying and selling. They're not afraid to concentrate their bets, and they're always looking for ways to capitalize on market inefficiencies. It's a very different approach, but their track record speaks for itself.
It does, and it's a valuable lesson for all of us. Sometimes the path less traveled can lead to some extraordinary outcomes.
Okay, so we've talked about their philosophy, their unique way of looking at the market, and their bold approach to portfolio management. But I'm curious to see how this all comes together in their actual investment decisions. Can we maybe dive into some specific examples of their wins and losses?
Of course, let's revisit their investment in Disney. Remember, they bought in when Bob Iger became CEO in 2005. And it wasn't just about Disney being a good company, it was about seeing the potential for a great leader to unlock even greater value.
So they saw something in Iger that others missed. What was it about his leadership that impressed them?
Well, he had this very clear vision for revitalizing the Disney brand. One of his first big moves was acquiring Pixar Animation Studios, bringing in this incredible talent and, a whole pipeline of blockbuster hits.
Oh yeah, that was a game changer.
Yeah.
Pixar was already like a powerhouse in animation. But Iger didn't stop there, did he?
No, not at all. He went on to orchestrate the acquisitions of Marvel Entertainment and Lucasfilm, bringing the superhero universe and the Star Wars franchise under the Disney umbrella. And these weren't just random acquisitions. These were strategic moves to build a global entertainment empire.
And it worked. Disney stock just soared during Iger's time as CEO. Giverny recognized his leadership potential early on, and they rode that wave to a massive gain.
It's a perfect example of their philosophy in action.
Yeah.
Finding a company with strong underlying assets and then betting on the right CEO to unlock its full potential.
Exactly. Now let's contrast that with their Amazon miss. They acknowledged the potential of e-commerce, but they hesitated questioning Amazon's valuation and its unconventional approach.
Yeah, they even called it a cult stock, right? Hindsight is 2020. But that one must have stung a bit as Amazon's stock just kept climbing.
It's a valuable lesson for all investors. Sometimes a company's growth trajectory and its disruption of an entire industry, it can justify a premium valuation. Being too fixated on those traditional metrics, it can cause you to miss out on some truly groundbreaking opportunities.
So it's about finding that balance between, disciplined valuation and recognizing when a company is truly rewriting the rules of the game. Sounds like a tough needle to thread. It is, and it really highlights a key takeaway from Giverny's journey. Investing is as much an art as it is a science. You need to be able to analyze the numbers, understand the businesses, and also have a feel for those intangible qualities that separate the truly great companies from the merely good ones.
Speaking of intangible qualities, I've noticed that Giverny puts a lot of emphasis on the people behind the businesses they invest in. It's not just about spreadsheets and financial ratios. It's about understanding the leadership, the culture, the vision.
That's a crucial part of their process. They firmly believe that great companies are built by great people. So they invest significant time getting to know the management teams of the companies they're considering. They attend industry conferences, they visit company headquarters, they even read biographies and interviews, just to gain insights into what makes these leaders tick.
It's like they're looking for those underlying personality traits that drive the passion, the integrity that separates exceptional CEOs from the average ones.
Exactly. And they've demonstrated a remarkable ability to identify those exceptional leaders early on. Think about Bob Iger at Disney, George Gleason at Bank of the Ozarks, even Michael Pearson at Valiant Pharmaceuticals. Despite the controversy that later surrounded that company, these are just a few examples of CEOs they backed who delivered impressive results, at least initially.
It's almost like they have a sixth sense for spotting leadership talent.
Yeah.
But I suspect it's more than just intuition, right?
You're right. It's a combination of meticulous research, deep industry knowledge, and a knack for asking the right questions. They really dig deep to understand these leaders, their motivations, and their track records.
It's a good reminder that investing is not just about numbers. It's about understanding the people behind those numbers. So as we wrap up our deep dive into Giverny Capital, what are the key takeaways for us? What can we learn from their journey?
I think the biggest lesson is that successful investing, it's a long game. It requires patience, discipline, and a willingness to stick to your convictions even when the market is testing you.
Yeah, it's about tuning out the noise, focusing on the fundamentals, finding those high-quality businesses, understanding their leadership, and buying them at the right price. It's not about getting rich quick. It's about building wealth steadily over time.
And Giverny's story is proof that this approach, while not always easy, can be incredibly rewarding. They've generated exceptional returns for their investors while staying true to their values and their unique investment philosophy.
And their annual letters are like a treasure map filled with wisdom and insights. They remind us that making mistakes is inevitable, but learning from them is essential. They challenge us to be intellectually curious, to question conventional thinking, and always be open to new ideas.
Their success really underscores the power of independent thinking and a long-term perspective in a world that's often obsessed with short-term gains.
So as we close out this deep dive, here's a final thought to ponder. Can Giverny's approach continue to thrive in a world that's changing faster than ever, driven by these rapid technological advancements? Or will they need to adapt and evolve to stay ahead of the curve?
That's the million-dollar question. Only time will tell, but given their history of adapting and learning, I'm inclined to believe that Giverny will find a way to navigate the challenges and opportunities that lie ahead.
That's a great point. They've consistently challenged conventional wisdom and found success by forging their own path. So keep your eyes on Giverny. Keep learning from their insights, and who knows, maybe their journey will inspire you to find your own path to investment success. Thanks for joining us on this deep dive.